Hey, everybody. We're doing a webinar today on these new loan level price adjustments. Man, it's been a long time since Shane and I have heard so much hoopla and nervousness and confusion over what does this mean? What is a loan level price adjustment? How does this affect me? How does it affect my clients? So what we wanted to do is just to do a quick webinar and explain to you, number one, what loan level price adjustments are, who is FHFA that everybody's talking about, and what does this mean to interest rates? So with that said, I'm going to go ahead and first of all say hi to Shane.
Oh, hey, how's it going?
All right, here we go.
Been a lot of hoopla. Yep.
That's right.
TikTok, Facebook, Instagram, MySpace, if you had it, there's been a lot of people talking about it. And like anything else in the media and online, there's a lot of smoke. There's a lot of, mystery and some of it that you're hearing and seeing is not true, frankly. So we want to demystify, what's happening with the hoopla.
I just love that I got my 34-year-old son to say hoopla.
Hoopla. Yeah, it's my favorite word, actually. It's my middle name.
All right. So the first thing we're going to do is we're going to talk about, how the fees, who is FHFA, what does an LLPA mean, and how this is going to affect you. So first of all, let's go to who is FHFA. So FHFA is the Federal Housing Finance Agency, and FHFA is the governing body who oversees Fannie Mae and Freddie Mac. Now, Fannie Mae and Freddie Mac are what we call GSEs, government-sponsored entities. What their sole job is to do is to purchase homes on the secondary market to keep the market liquid, right? So when you have a company that loans out, let's say $30 billion, the only way they're going to loan out $30 billion the next year is they have to be able to sell these loans on the secondary market. Most people will never even know this happens. If you own a home out there, there is a really, really good chance that either Fannie Mae or Freddie Mac owns it on the secondary market. Now you may say, Barry, I still write a check out to whoever it is. Well, that's what we call a servicer. So if your servicer is United Wholesale Mortgage or whoever it might be, they're just collecting the money and then they're taking out a small portion and giving that over to Fannie Mae and Freddie Mac. FHFA, they are the governing body of those two entities, and that is what we would call a conventional loan. Depending on where you live at in the country, what that loan limit is it will dictate whether or not you're going to try and go for a conventional loan. Or you could possibly also go for an FHA loan. Government loans like FHA and VA, they are governed by Ginnie Mae. And FHFA doesn't have any control over Ginnie Mae. It's strictly over Freddie Mac and Fannie Mae. So then that's what we would consider to be a conventional loan. So a lot of people don't understand what that means, but you just have to understand that, like all lenders, if we're facilitating a conventional loan, we have to go by Fannie Mae and Freddie Mac guidelines. And Fannie Mae and Freddie Mac are actually, they have a huge metrics of what we would call hits. People wonder why the interest rate varies from whether you're buying a single family residence or a condo or a primary residence versus an investment property. So I'm going to let Shane take over and explain to you what a hit is and how that affects interest rates.
Yeah, so to Barry's point, not just on conventional loans with Fannie Mae and Freddie Mac, but across the board, there are these things called hits or LLPAs. Again, if you're on TikTok, if you're on any of these sites that are talking about these new hits, it's basically, traditionally or historically, the hits are when there's layered or added risk to any specific loan, any packaged loan. To Barry's point, if it's a condo, if it's a single family, if it's an investment property, the more layered risk, the more of a hit you will take to the interest rate, because from an investor's standpoint, it's a riskier loan, right? So for example, if you're buying a condo versus a single family residence, there's generally a slightly higher interest rate or a slightly higher cost because of these hits. So this graph, this chart that we have laid out, this is just one investor and basically all of the different hits that they have depending on certain criteria. But there's a lot that goes into it, right? So the interest rate isn't the same for an investment property versus a primary purchase because of that risk. So for example, if you look at also, if you're looking at FICO, that's generally, historically, there's more risk when you have a lower FICO because again, their credit history may not be as clean, right? So for example, in the purchase there, you see if you have a 780 FICO and you're buying with, say 70% or rather 30% down, your loan to value is 70%, there is zero added hit, right? There's less of a risk there as opposed to that same client buying with a 780 FICO, buying with only say 10% down, that second to the right bracket, there is a hit of 0.25 or 25 basis points. Again, added risk, right? That client, that borrower is putting less down. So there's more risk involved of theoretically a foreclosure or default, something to that effect. So across the board, we're not going to go into all the nitty gritty of all of the different hits. But again, you can see if you go further down to the bottom left there, high balance fixed purchase in RT, which is rate and term purchase or refinance. There's high balance cash out ARMs. There's, if you notice, in pretty much all of those brackets there across the board, those are some pretty substantial hits because again, there's more risk there. If you have a high balance loan, which is above what the traditional conforming loan limits are, and you're pulling cash out, there is some added risk there because the lender isn't necessarily sure exactly what you're doing with that cash. Now your loan to value is going up. So again, there's more risk involved. Those are what traditionally these hits are, or loan level price adjustments. So we'll go into next really what this new changes that FHFA has brought into it and what they've done. In the news, in articles, you're saying a lot of people are freaking out saying that, well, someone with a 680 FICO now or 660 FICO is getting a better interest rate than someone with a 780 FICO putting more down. That's not necessarily the case. It's a bit convoluted even for experts in this industry, but that's not the case. And again, we'll be able to illustrate that, but I'll pass it back to Barry to look at the new LLPAs.
Yeah, before we go over to the heat map to show you guys, to Shane's point, I want to point out, like, if you look at, let's say, a purchase and we go over to 20% down, which is 80 to 85% LTV. That's what this means up there. You can see how the hits just get incredibly large when you get down to somebody who has a 620 credit score or a 640, because as Shane pointed out, they felt like borrowers who had that credit were riskier, right? So therefore, it translated into a higher interest rate. So the new loan level price adjustments that we're going to look at doesn't necessarily mean that all of a sudden somebody with a 640 credit score has a better deal than somebody with a 780. What they did is they just narrowed it a bit. They made it a little bit more affordable for somebody who's just getting started out and doesn't have the greatest credit or doesn't have the largest down payment. And they've made it just a little bit more of a hit to somebody with great credit. So let's go over and we want to take a look. This is the new heat map showing these new added loan level price adjustments. Because remember, there was always loan level price adjustments. These are new ones. And I don't want to break your brain, so I'm not going to go through every single one of them and try and explain anything, because honestly, we're all still kind of scratching our head. But there is a theme here, folks. When you see dark green, this means this is the greatest change with the new loan level price adjustments. So you don't have to be a rocket scientist to look at this and notice that if you have less than 5% down, that's what this means, over 95%, and you have a 639 credit score, it's giving you an extra 175 basis point hit to the positive versus the way that it used to be. Okay. If you have a 680 to 699 credit score, again, less than 5% down, it's not as dramatic as it is there. But let's just go back to that other screen, and you can see that less than 5% down was 175 basis points hit. So, they're making it not as dramatic to try and allow people that don't have the greatest credit to be able to get a conventional loan. The unfortunate thing about this is that, the people that do have great credit and have a really good, down payment. I mean, look at here in the red. If you're putting down 15 to 20%, you're actually getting hit with a worse rate than you would have before. So these are the people that are the most that are being affected by this: 740 to 759, 720 to 739. But the people to the negative, the people that are benefiting the most are the people with less credit, with less money down. I think that most of you that are in this business that are watching this know that over the last 3 years, there's been a lot of institutional buying, folks. All these cash offers isn't because somebody all of a sudden got rich and won the lottery and they wanted to buy a bunch of houses. These are hedge funds coming in and buying huge swaths of real estate. And it's left, the little guy out there who's just trying to get started, kind of powerless. So they're just, in their really weird way, they're trying to even that out. But we're going to show you that isn't necessarily, even though they did that, the best way to go. So what I did, or what Shane and I did, is we took 5 different scenarios to show you guys, why we believe, even though they came out with these loan level price adjustments, that there is a better way. So the first example we put was a 20% down payment with a 720 FICO score. The interest rate at the time when we put this together yesterday was like 6.75%. This is on a conventional loan. The principal and interest rate would have been about $5,189, and then all in with principal, interest, taxes, insurance, PITI. I don't think we used any HOA here. It would have been about $6,397. Now, with 10% down on a 720 FICO score, dramatic increase in the interest rate.
Yeah,
from
real quick.
6.75 to 7.5.
Real quick, I want to point out, it doesn't show it here, but the purchase prices on these, if you kind of reverse engineer,
$1 million.
$800,000, that's $1 million purchase. So these scenarios are on $1 million purchase. Sorry.
Good point. Thanks for interjecting that, son. $1 million purchase. First one, example, 20% down. This one is with 10% down. You can see a major jump in the interest rate, 6.75 to 7.5, which most of you would probably go, well, that makes sense because I'm putting less money down, right? But what you're looking at here now is a principal and interest rate. Instead of $5,189, the payment jumps significantly, not just because of the interest rate, but remember, you're also getting a bigger loan because you're putting less money down. All in, instead of $6,397, you're at $7,847 for the PITI. Now, if we go over here to a conventional loan with 20% down and a 780 FICO score, you can see that the interest rate from if you had a 720 FICO score, only went down about 1/8 of a rate. And the principal and interest payment, instead of $51.89, is $51.22. Now, again, I don't think that's really life-changing. It's not magical. Instead of $63.97, you're at about $6,331. So why is it that your monthly payment is that much? Because we're talking about 1/8 of a rate between the two. But now let's jump over. This one's kind of a head scratcher. If you've got a 780 FICO score and you're only putting 10% down, instead of a 6.625%, now you're at a 7.25%. And now we've got principal and interest payment of $6,140. and you've got a month and a PITI of 7,558. Well, what's been added to that, and I forgot to mention that, by the way, over here too, is you've got mortgage insurance because you're only putting 10% down. So instead of, with the same example, 720 FICO score would be 6293. It's 6140 with the 780 FICO score. Again, not life-changing money, right? Even though you're paying mortgage insurance. And the reason why is because you're taking out more of a loan than you would have, let's say, with 20% down. Now let's go all the way over to FHA. Guys, we're using 10% down. We all know that with FHA, you can come in with as little as 3.5% down, but I wanted to use 10% down, as if this could be an alternative for somebody. Maybe they do have great credit, but they only want to put 10% down. We're going to compare that to the 720 FICO score with 10% down over here. You look down, the interest rate instead of 7.5% is 6%. That's a 1.5 lower for the FHA loan. So when you go down to your principal and interest payment, it's $5,396 for the principal and interest payment. You'll notice that the mortgage insurance is a little bit higher than it is over here in this example. Again, both 720 FICO scores, both 10% down. So it is a little bit higher, but the interest rate is so dramatically different that by the time you take your principal and interest payment and you add up principal, interest, taxes, insurance, and mortgage insurance, you're at $7,130. So your monthly payment is $7,130 instead of $7,847. But notice that it's still more expensive than it would be if you were coming in at 6.75% with 20% down on the 720 FICO score. So the reason why we wanted to share this with you is because we believe that let's get back to the regular screen.
Can you go back to that real quick, Dad? I want to point out something.
Sure, go ahead.
So, obviously FHA is an incredible solution for someone who's putting 10% down now, as opposed to, previously to these new hits, we wouldn't have steered them in that direction because FHA has a UFMIP, which is an upfront fee. But one of the things I want to point out is, again, back to the hoopla, right? You guys are seeing a bunch of stuff that's saying that, well, if you have a better credit score and you have more money down, you're going to have a worse interest rate than a 640 FICO with less down. And that's just not the case, because again, there are loan level price adjustments throughout. Although they've changed some of the loan level price adjustments, because there are added loan level price adjustments already baked in, there's not a huge difference. So for example, that 720 FICO person who's putting 20% down is getting an interest rate of 6.75. But if that same person had a 780 FICO, which is better, with 20% down, that 780 FICO score individual is getting an eighth lower interest rate. So that information that's been floating around saying that people with higher credit with less down are going to get worse interest rates is just not true. So again, I wanted to we obviously dove into the numbers, but I wanted to show you, in plain black and white that information that's been floating around is just a falsity. But yeah, I'll pass it back to Barry.
No, that's a great point, son. And the other point I think to make here, because you kind of touched on it, is that, the other thing that comes along with an FHA is this thing called UFMIP, which stands for Upfront Mortgage Insurance Premium. It's a one-time fee that you pay to FHA for the privilege of doing an FHA loan. This is how they make their money. Well, on $1 million property, it would be about $17,500 because it's 1.75%. It gets rolled into the loan. But if you look at the difference in the monthly payment between these two, it's about $8,600 a year. So if you're going to stay in the loan longer than a couple of years, the UFMIP actually winds up being the best way to go, because over the long run, you're going to save more money. But Shane and I have always looked at an FHA loan as something that it's something to get somebody into a house for relatively little money, especially if you don't have great credit. Where you don't see this yet, where it really explodes the difference between FHA and conventional is when you get down into the sixes. When you get down to 660 credit score, 670, the mortgage insurance skyrockets, the interest rate skyrockets. But guess what? With an FHA loan, it doesn't. I would almost guarantee you that if we looked at the pricing right now, I'm not going to do that, that you would see that it would be the same interest rate for an FHA loan if you were at 680 credit score as opposed to a 720. So I think it's important. Just keep in mind that nobody expects you guys to know all of this. In fact, Shane and I have had to eat some aspirin over the last couple of days trying to figure out how we were going to explain this to you guys. Most of this stuff is automated with a lender, but a really good lender is going to be able to not only sit down and explain this to you, but it's going to take the time to make sure that whatever advice they're giving to their client, it's tailored to that client's needs. It's going to be different with everybody. You know, somebody who wants a conventional loan, if the conventional loan makes more sense, they're not only helping them get the conventional loan, but they're explaining to them why a conventional loan is the best solution for them. If they're saying, hey, an FHA loan is gonna work for you better, you don't just put somebody into an FHA loan. You go through it and you explain to them and you compare the FHA loan to the conventional loan and why you believe FHA is a good decision. So whoever your lender is out there, I hope that they are going through this with your clients, because ultimately, folks, if you are a realtor or if you're a financial planner, the best thing you could have is an educated client who's able to make intelligent decisions. Can't make an intelligent decision unless you have the information to digest. Now, some of our clients, they just like, whatever, guys, like, we trust you, you know, we know you're going to do, and they don't want to go too deep in the woods, but it's amazing how many of them actually do. They go, you know what? Nobody's ever actually talked to me like this. And then they go out with confidence and they swing for the fences and they get an offer accepted. So I hope this helped you guys out. Son, you got anything you'd like to part with?
Yeah, I do. There's, you know, one thing I'll say is that most lenders, most investors have baked in these changes already. So I had an agent partner reach out to me and say, I have 2 clients that were pre-approved that are actively looking for properties. And they called me and said, you know what? I don't want to go look for properties anymore. I don't want to buy. I saw this in the news. This is complete BS. And again, to Barry's point, they just frankly weren't educated. Their mortgage advisor didn't talk with them and show them exactly what the difference is, if any. And those same clients were probably quoted a rate that already had these baked into it. So again, you just want to make sure that whether it's, don't juggle all these different plates, right? You don't need to go in and start explaining to them exactly what the changes are and all that, but don't let this discourage your buyers. This change has frankly been blown out of proportion. It is, you know, the word for the day, hoopla. And again, I think that we need to make sure that clients, agents are educated and also know that there are other solutions in mind. The FHA loan is a great loan. Some agents are afraid to accept an offer with that. But frankly, we just had an FHA loan that we closed in 15 days. So there shouldn't be anything someone's afraid of.
And a VA, we closed in 15 days.
VA, yeah, we can, you know, we got gold medals across the board for those. But that's really all I wanted to add is that, you know, a lot of this has been baked in. And this should not deter buyers from going to look and buy, because rates are coming down a bit and they're going to come down even further this year. And there's going to be a mass amount of people that have been on the fence that are going to jump back in regardless of the LLPAs and the changes. So that's all I wanted. I'll leave it with. And I appreciate
I want to add something to that, because, you know, real lenders who've been doing this for a while know that this is not new. The reason why this is new is because they're making it for conventional purchases, second homes, investment properties. Back after the lockdown happened, there was $11 trillion worth of mortgages in the United States, of which like half of them were refinancing all at once. This was right after May, going into April, May, June, and July. I mean, guys, it was bananas. I was breaking out in hives half the time. I couldn't answer my phone quick enough. I mean, it was just, at one point, I think Shane and I had like 30 active loans in our pipeline. And all of a sudden, FHFA came in there and just whacked everybody, literally overnight. Rates went from 3% up to 4.25% overnight. And we just watched our pipeline slowly disappear. The majority of people stuck in there with us. And then eventually they pulled the LLPAs back. So this is nothing new, folks. It's just new because, you know, it's affecting people that are buying right now. And honestly, I just think that it's clickbait, right? All these news stations that want to keep your eyes glued. They want to tell you all the bad news that's happening. Well, you know what? Some good news is happening is that the market's picking up. And more than likely, we're going to see lower interest rates in the course of the last half of this year. Everybody that Shane and I listen to has been predicting this, including Barry Habib with MBS Highway, who we listen to like a hawk. And so the chances are that things are going to get better. Don't let this discourage you. Keep a smile on your face and know that you're helping people. With that said, thanks for joining us. I hope you guys have a wonderful day and the rest of your week.